Hi everyone, welcome back to another episode of Superprime UK. Myself, James Wilds, and we've got a special guest on today, one of my colleagues, Kevin Biggs, Head of Risk at MJ Group International. Kevin's background, he's going to tell us a little bit more about it, but it's more a risk and banking sector.
Yeah, I was at RBS for a few years and was the valuation panel manager for several of those years, dealing mainly in development and commercial property, but joined MJ Group 2 or 3 years ago now, and enjoying it. It's a different challenge, working for RBS to working for MJ, but I'm enjoying it thoroughly. So yeah.
Thanks, Kevin. It's more than a few years, I think, as well.
Oh, there you go.
Industry experts. But in terms of data this week, I want to just come on and chat to you guys. We've obviously had the Easter long weekend recently, so I think it's affected the data and some of the market activity. In terms of some of the sold transaction figures over the last couple of weeks, we've had 88 and 97. New instructions have picked up this week to 308, whilst previous week lingering at about 220. Fairly good pipeline still for this week in terms of under offer properties at 189. So we're going to have to see how the figures and numbers transfer in the coming weeks. We've obviously got 2 further bank holidays coming up in May. Kevin, we wanted to talk about today in terms of some of the other market indices and house price indexes. We've got obviously Halifax reporting slightly more optimistic data than nationwide. So we'll just start with Halifax for the time being. Monthly growth has switched to positive at 0.8%. So
off a very low base, relatively.
Yeah, it's been obviously sort of. Again, the 2 sets of data have different low points, but I think in those weeks and months after the mini budget and Liz Truss, I think is fairly accepted as the bottom of the market, and that coincided with the interest rates really starting to grip in terms of the cost of living crisis as well. Just on an annual basis, the Halifax data first, house prices, they're still producing positive annual growth, so 1.6% higher than a year ago. However, this is the weakest annual growth figure we've had in 3.5 years since October 19. Again, coming off the Halifax data's peak of the market, which was June 22, whereby there was annual price growth of 12.5%, which obviously that month, Kevin, was the real peak where the stamp duty holiday came to an end and everyone was rushing on those sort of March and June dates to get their property transactions over the line and transacted.
Yeah. But the trouble was that they were all clogged up because the solicitors and everybody else was just absolutely swamped.
Yeah.
So actually all that was happening, my view, was that the actual time to get a deal across the road was just extending further and further away. So people were getting pushed into real difficulty with their just completing the transactions. So the conveyancers were totally and utterly swamped, and they didn't have anywhere to go with it really. So I don't know that that's actually going to generate any more activity. I think actually it's just showing that there's actually a heck of a lot of backlog of deals that are still struggling to get over the line. I'm from personal experience, I know my son has been trying to buy a house since September last year, and he's only just completed this last week. And a lot of that was just down to the conveyancers not being able to get it over the line. And indeed the chain just getting extended,
Yeah.
particularly into the new builds, because the new builds were being delayed, and that the top of that chain was just people were not completing their houses. And I think that's led to even longer delays in terms of actually deals being done.
Those long sort of chain transactions.
Yeah.
And if one deal falls through, it sort of breaks the whole chain. So during that period we referenced, we obviously went from gazumping to gazundering, sort of almost a new norm for that period, whereby the market was coming off and people were then sort of price chipping almost throughout the market. Things have stabilised so far, I think, in 2023 as we've moved through quarter one.
But do you think that's because everybody's expectation in terms of interest rates is actually, whereas people were thinking it was going to go up to 6% or something like that.
Yeah.
Now I think people are sort of considering that 4% might be the norm for a while. New norm.
Yeah, I mean, people's fear of those rising interest rates has calmed, more as on the back of some of the sort of 5-year fixed rates now. I think you can get around 3.95%, which is just lower than the base rate, but obviously you're then locked in for a period of 5 years. So people just having that cost-benefit analysis weighing up, do they go on the trackers, the variables, they do even a 2-year fixed, just to see what is the most cost-effective solution to them and try and get the most economic deal they can.
Great.
Just switching over to the nationwide data and their indices for March. This is somewhat differing to the Halifax data. This saw a monthly price drop of 0.8%, and it also is the 7th negative data set in a row for the monthly data. Leaves us around 4.6% behind their August peak, as Nationwide had it, rather than at June. Like you say, Kevin, could have been some of those delayed completions just staggering over the next couple of months, and as Nationwide have it, August as the peak of their market. House prices down 3.1% year on year to March, so not, pretty different story to Halifax there. And it's just, obviously these are the two largest mortgage providers in the UK. It's just interesting how their data sets differ from one to another. Just in terms of more localised statistics there, Nationwide have got the West Midlands as the strongest performing market, while Scotland has remained the weakest.
And I think partially that is because of the expectation, which has now become more of a reality than expectation, that the holiday home market is going to be hit by the dual council tax, which is a bit of a creeping thing, because obviously Wales had that initially.
Yeah.
Now Scotland are bringing it in, and I think certain areas of the country, Norfolk and southwest England, are seriously considering that as a way forward to boost their coffers. Not sure the holiday industry is too happy to hear that.
No, obviously domestic holidays have become very popular the last 3 years since the pandemic, and domestic tourism has done extremely well. So they've maybe had a more positive period the last few years than anticipated, but now getting hit by something like, say, some of the doubling council taxes, some of the tax changes for those buy-to-let landlords. Although if you've got it set as a holiday let and company ownership, it's a slightly different structure there. But in terms of it almost follows on from that buy-to-let industry, and somewhat a lot of those career buy-to-let investors are starting to exit the market.
They are. They're rethinking their strategy and seeing whether now's the right time to perhaps look at an alternative, especially as interest rates are allowing them perhaps to see returns elsewhere that they weren't getting before. And this had been a sort of a place for them to find to lose their money for a while. So
that's it. If they can't convert it to an HMO, boost those returns, I think a lot more people are going to be exiting that market, especially if those more long-term investors and buy-to-let operators, they will have bought in at a much lower price. So in terms of, they won't be under pressure on the sort of on the baseline to sort of a break-even point. So they might take a view in terms of their property portfolio, sell it as a lot or piecemeal, start to break that up and sell off assets as they see fit, and try to strategically maximise their returns.
And also, I think the CGT, potential for uplifts in the CGT there. So people are looking to take some of the profit takers, basically.
And obviously, we've seen the rental market has been pretty hot the last 9-12 months. Everyone's rents are are going up. So it's quite a reactive change in the market there, and we're going to have to see how the market adapts, because I think as it stands at the moment, we're going to have less and less buy-to-let stock on the market for renters. So I'm not quite sure what's going to happen in terms of those. It sort of offers that flexibility in terms of city workers, young professionals, those people looking to get onto the property market, sort of still renting. What they're going to, how they're going to continue to rent properties in a more diminishing market.
And as you say, the rents have risen significantly, and if interest rates do perhaps get slightly better, or certainly borrowing rates do actually improve, then the market could see another shift. We'll see.
Yeah, possibly one more interest rate rise.
Well, yeah, I think there's a politics game here at the moment, I'm afraid. And dare I say it, we've got local elections next month, and I think that interest rate rises will, whilst Bank of England is independent, as we all know, I think that there will be significant pressure to keep interest rate rises as low as possible.
Yeah, just looking at some of the votes in terms of the Monetary Policy Committee members, whilst on the early rate rises, it was all in favour of the rate rise. There's been a bit more of a debate on the committee in the last few rate rises. So I think we're starting to see it plateau in terms of where that's going to go. Obviously, the Bank of England did say that it's going to peak at 4.5%. So whether that gives us one more rate rise or whether it's going to be 4.25, worth just mentioning about inflation has increased the last couple of months, gone back up to double digits there. So maybe we could surpass the 4.5% peak that was predicted previously.
Well, we've got, as you say, inflation sort of still unfortunately rising, and even whether it's 10 or 9%, that's still a significant increase in costs of your daily shop. Although, as I think you mentioned to me earlier, that obviously there's a bit of a price war perhaps on the offing in terms of the supermarkets.
Yeah, I think it's the cost of milk has come down. I know a lot of news outlets have been saying about is that the start of food prices starting to come down somewhat. Possibly maybe a slight squeeze on the farmers, or like in the UK, a lot of the big supermarkets can afford to have a loss leader in their store. Gives them a lot of marketing materials to advertise. They've got all the advertisements at the moment are about saving money yet spending money. Quite sort of clever advertising, and obviously it's sort of, I don't know if you sort of get in the supermarket chains, but of one-upmanship. Each one, that's Aldi, Lidl, Sainsbury's, Waitrose, Tesco, they're all involved in the price war at the moment.
Yeah, they're all playing a similar game, and it's all. But I mean, to be fair, there's a lot going on, and we've got obviously the proliferation of strikes potentially sort of drifting on into the summer, particularly with the nurses and the doctors, which perhaps not too effective on GDP, but it does affect people's ability to spend. So I don't know. There's a lot of economic change going on at the moment, but one would hope we've had Easter now. Traditionally, Easter was the big push in terms of sales of houses or buying of houses. Traditionally, you went out and bought your house now. Perhaps that's not been quite so much the case in recent years, but do you think that perhaps summer is the next traditional sort of boost to the market? Do you think we're going to get back to something away from the 3.5% fall? Do you think we're going to get back to a sort of a plateau and back to sort of no growth for 2023 rather than the predicted 5 to 10% growth, which was being talked about in September, October last year? again, trust time, but there you go.
In the 3-4 weeks up to Easter, there was some positivity in the property market. I think there was more transactions, more activity, especially that we were seeing on the ground sort of before all that data hits the official channels of the land registry and some of the data sets which get released. So there was some positivity there brewing prior to Easter. Again, that sort of affects 2 or 3 weeks of people going away, and obviously 2 4-day weeks there and another couple of bank holidays to go. So I think the sort of spring bounce could be somewhat delayed towards more the sort of mid to end of May before we see some of those.
So we have a coronation bounce.
Well, we quite possibly coined a term there, Kevin. But I think there could be, like we said, a bit of a spring bounce there in the market. Hopefully the nationwide in their statistics, maybe they sort of start to turn and more align with the Halifax statistics. Certainly I wasn't too surprised when those got released at the start of the month in terms of the Halifax, because it's what we were saying on the show for the last few weeks. There had been more sales and positivity. I think what we could revert back to is the sort of a 2 or 3 tier market in the UK in terms of London performing very differently to some of the rest of the market. And within London, there's definitely some sub-markets in terms of different areas, and super prime has been performing extremely well since the pandemic and continues to trade very well, particularly at that 10 million plus mark.
Which is encouraging. And are the buyers for there? Are they UK buyers, or where are they principally coming from?
So in terms of what we have seen a presence of some UK domestic buyers at that level. Obviously, a lot of international buyers, particularly from the Middle East, but also in the last 12 months, a lot of American buyers maybe making use of the slightly weaker pound. A lot of Asian buyers in that makeup as well. So the sort of the usual suspects and usual sort of mix. I don't think there's been a big shift in terms of those sort of subsector of buyers in that super prime space. But in terms of activity, has definitely been up, and in terms of the amount of money spent in that market, has definitely increased year on year. And I think obviously, Kevin, at that mark in the property sector, it's very reliant on what is available at those particular times, and are people willing to sell? I know a lot of it is off-market transactions, but it's just in terms of what becomes available at what time, and then what buyers are there and are willing to pay those asking prices at a given level.
So it's a good old thing of supply and demand, balance and imbalance. So with that in mind, I would have thought that there should be looking perhaps into newer developments of £10 million houses, and yet it doesn't seem to be happening, does it? I mean,
there's very limited new build houses at that sort of price level in central London. Chelsea Barracks is probably one of the very few. Okay. Starting prices there around £40 million for a townhouse. But in terms of most of the luxury developments, it's all flatted schemes, and it's all about that placemaking, and it's almost like a 5 or 6 star hotel and the amenities which are on site. And there has been in the last 3-4 years a real emergence of those schemes, particularly around your sort of prime central London areas.
Presumably driven by the fact there's just not the land available.
That's it, yeah. In terms of it's so built up, and in London and the UK, we've got a very good, in my view, a very good planning scheme whereby quite protective of some of those sort of more sacred greenbelt areas, and most of the sites which have come about have been sort of repurposing of land, or the brownfield sites which have seen the pipeline of development.
Good.
Well, no, thanks very much for your time today, Kevin, and coming on the show.
No problem. It's been fun.
That's it. Well, great. Thanks. Thank you to Kevin again, and thank you very much to everyone tuning in. We'll be back in a couple of weeks' time for another show.
Okay. See you soon. Cheers.